Hello, a company voluntary arrangement, also known as a CVA, can help a business that's suffering from creditor pressure as a result of historic losses or cash flow problems. So, what is a CVA? Kevin.
Think of a CVA as a mechanism to give your company more time and legal protection from creditors to sort out its financial affairs.
And how does it work?
It's essentially a deal with your creditors to freeze your debts and repay them over a period of time. As part of the arrangement, we can even write off some of the company's debts. It protects the company from all creditors, including HMRC, from issuing winding up petitions or other aggressive legal recovery action. It's one of the best tools we have to protect companies that are in trouble.
What situations lead to a CVA?
A business can suffer a sales downturn or an unexpected cost like an industrial tribunal award. It may simply not be able to afford to restructure its employee cost or even terminate property leases it no longer needs and financial obligations. When cash flow is sufficient for current business expenses or working capital but cannot handle its historic debts or claims, most directors start to juggle cash to pay those creditors that threaten the loudest. However, you've got to remember that the company can fall quickly into insolvency, so you need to act fast.
So if you just need to get things back on track, a CVA may be the best solution.
Yes, a CVA proposal is a deal with your company's creditors that allows the company to freeze its debts and pay them back over a longer period of time, and possibly even write off some of the amounts you owe. It also protects the company from aggressive legal recovery action from all creditors, including HMRC, with the help of a legal moratorium. You need to think about this as a ring fence which protects the company from legal recovery action and litigation such as winding up petitions and county court summonses from creditors.
And how long does it take?
Approximately 4 to 6 weeks is a typical time frame. We do require directors to work with us in preparing a CVA, which is a detailed proposal for creditors to consider. Certainly we find a good detailed proposal will get the support of HMRC.
Do all creditors, including aggressive creditors, have to support the CVA?
No, the Company Voluntary Arrangement does not require all creditors who owe money to agree, and we can bind aggressive creditors as part of the CVA proposal. The CVA will protect the company from legal action, and it gives it a bit of breathing space, which might be all it needs to return to profitability.
And how does the vote work?
Well, the actual vote process is quite complicated. So I'd refer you to our other videos or the FAQ section on our webpage, or even better, give us a call to get a better understanding. Simply stated, we secure over 90% of our CVAs with the consent of creditors. And yes, this means we bind those who don't agree to support the proposal.
What about secured creditors like the bank?
Secured creditors do not vote in the CVA. And by getting control over the unsecured debt, your bank position and relationship should improve. Because the result of a CVA on cash flow is so positive, the secured lenders, like the banks, are normally happy to give consent.
Do companies need to inform their customers?
We're under no statutory duty to inform your customers or your clients, and in fact we have no desire to write to your customers about the CVA.
Okay, so once you're in a CVA, the company continues to trade and the directors are still in charge. That means you're still in control. You can turn things around, and that's what it's all about. If you'd like any further information about CVA, then please contact us on the number that's on the screen right now.